Good afternoon. This is Anna Pinedo from Mayer Brown, and we thank you for joining us for today's webcast on preparing periodic disclosures for life sciences companies. Before we get started, just a few housekeeping comments. In order to ask questions throughout today's program, you should type in any questions on the Q&A widget, which is located on the bottom of your screen, and we'll try and answer them during the course of the presentation. Otherwise, if we don't get to a Q&A question during the presentation, one of us will follow up with you by email with a response. For those of you who would like CLE credit for the live version of today's program, if you access the resources widget, you can download both the affirmation form and the evaluation form. We'll announce the CLE code at least once during the middle of the presentation and once before the end of the presentation. You'll see instructions for returning both forms in order to obtain CLE credit from Mayer Brown. Finally, you can download the slides for today, as well as some supplemental materials, which include 2 EY publications that cover some of the topics that we'll be discussing today, as well as some Mayer Brown alerts, also from the resources widget. And then finally, we'll distribute all of the materials today to the webcast registrants by email shortly after the conclusion of today's program. So with that behind us, during today's session, we'll be covering SEC comment letter trends. So looking back a little bit into 2019 and comparing to prior periods and looking at the topics on which the SEC staff has been principally focused during its review of 33 Act and 34 Act filings. We'll talk about recent accounting pronouncements that affect life sciences companies, including RevRec and Lease accounting. We'll talk about some other areas of SEC disclosure focus, and then we'll finish off with proposed amendments to Regulation SK and Regulation SX. Today at Mayer Brown, we're very pleased to have as a guest speaker Polya Nair join us from EY, and I'll just ask Polya maybe to say a few words and introduce herself.
Thank you, Anna. So some of our audience may remember me from last time when we did this presentation together. I spent effectively all my time working for the National Office of EY in a small group of subject matter experts that dedicate all of our time to SEC reporting disclosure and monitoring SEC staff comment letters and working with the SEC staff to support our assurance clients. And with that, I'll move into our first topic for today, SEC staff comment letters. We prepare a very comprehensive analysis once a year based on comment letters on Form 10-K for the last fiscal year ended June 30th of every year, and we did that as well as of June 30th, 2019. And the comparative statistics listed in the table on this slide show us how the trends are moving at a very, very high level. So not surprisingly to everyone, since 2018 was the first year when public companies adopted the new revenue standard during 2019, the significant bulk of SEC staff comments were on that topic and were questioning how companies were adopting the new revenue standard and whether they were providing sufficient disclosure to satisfy the objectives of the disclosures in the standard. Non-GAAP measures was the second topic. It's sped ahead of management discussion and analysis, which historically was the number one topic, and then follow fair value measurements, intangibles and goodwill, and income taxes. The dispersion of comments for foreign private issuers is very similar to what you see here for annual reports on domestic registrants as well. And with that, we'll move into some example comments on the new revenue recognition standard. So most of the comments that the staff issued over 2019 and 2018 on the new revenue standard were simply questions to the company asking for more clarification on the specifics of revenue arrangements, to shed light on whether the disclosure is appropriate and extensive. And very, very rarely registrants had to make restatements. Most of them resolved the SEC staff comment by simply expanding the disclosure that they were providing in their periodic filings or registration statements. The SEC staff continues to encourage registrants to refine their disclosures and supplement it in future filings, particularly around areas that are very subjective and subject to deep judgment by the registrant that warrants contemporaneous documentation. And here are a couple of comments. The first one related to the cumulative adjustment upon adoption of the revenue standard on 1/1/18. The staff noticed that that cumulative adjustment figure contained a one-time impairment and questioned why. On the surface of it appears unusual. The second one is questioning the methods and assumptions and is basically asking for a more thorough disclosure of the method applied to estimate variable consideration and the significant assumptions. In this table, we have presented a summary of the most frequent elements of the revenue recognition model that have warranted SEC staff comments over the last year. And on that, I'll just mention principal versus agent considerations. Some registrants in some industries are more susceptible to get these particular comments, not heavily in the life sciences industry. Non-GAAP measures, the second most frequent topic. This area became, probably the second or third in terms of number of SEC staff comments since May of 2016, when the SEC staff issued a series of new interpretations. And the comments focused initially on a broad range of topics, from prominence to non-GAAP measures that may be misleading, describing more clearly the reasons for using the non-GAAP measure and its usefulness to investors as opposed to only management. But more lately, the comments are focused on principally two elements of the staff's interpretive guidance. The first one is making a lot of adjustments for recurring cash expenditures, and the second one is tailoring GAAP accounting principles. So if you look at the first and the third example on this slide, they are squarely in line with those two new focus areas that we have observed in 2019. So in the first one, the staff has spotted that a particular registrant has incurred upfront collaboration expenses, but has been removing those in multiple periods from its GAAP performance measure to derive a non-GAAP performance measure. And the exclusion of a recurring cash expenditure could render a non-GAAP measure misleading, namely because it's providing a non-GAAP measure of core earnings that is removing a large portion of the costs of the company that are also associated with cash. In the third case, this particular registrant was questioned whether it was tailoring accounting principles by providing a non-GAAP measure that was including adjustments to remove upfront fees or include upfront fees in the amount of revenue, which effectively places revenue not on accrual basis of accounting, but on cash basis of accounting. And with that, I'll hand off over to Anna to chat a little bit about research and development, trials, and studies.
Sure. So, of course, R&D costs are usually the most important element for life sciences companies. They generally spend billions of dollars on R&D costs, and for life sciences companies, the SEC staff rigorously reviews the disclosures in MD&A and throughout the registration statement or 10K on R&D trials. And so among the things that the SEC staff has asked about is for life sciences companies with significant R&D costs to try and identify the current status of clinical trials for each product candidate and to present the results for each phase of the trial. It's also important for life sciences companies to provide disclosures that, to the extent that they track their R&D spend by project and by period, that they present the costs on a by project and period basis. So on the next slide, you see some samples of SEC comments that have been issued relating to R&D expenses. So the first, an analysis of R&D expenses by year by candidate, as I was mentioning, a breakdown of expenses by year and by candidate or by product. Usually if a company responds that it doesn't track the expenses for R&D by product or by candidate, it's helpful to include some discussion that's qualitative that helps identify whether, in fact, the company tracks expenses perhaps by stage of development or otherwise. And if one of the goals in preparing SEC disclosures, again, whether 33 Act or 34 Act disclosures, is to anticipate, then it's helpful as a company to consider whether you want to just be more forthcoming and in your MD&A identify the whether the company does track and how the company tracks the amounts, and then of course to provide disclosures regarding capitalizing any pre-launch inventory, capitalizing inventory that hasn't been approved by the FDA, quantifying the total amount of capitalized and unapproved inventory, and addressing other related topics when talking about R&D spend. So the other area that is a frequent source of SEC comment is, of course, the MD&A section. The MD&A section is really intended to provide a perspective for a reader or a potential investor of the company's financial results and its outlook as if it were at the company. So insight into the company's results of operations on a period-by-period basis, as well as insights relating to known trends and uncertainties. So item 303 of SK governs and provides the general instructions for preparing MD&A disclosures. The SEC staff in recent periods has been focused on trying to engage registrants and encouraging registrants to explain their results of operations with greater specificity. So they want to see an explanation and a quantification of the period-to-period changes for anything that's material. So you might see a comment that asks that the registrant revise to quantify the impact of each material factor. That way, a reader is going to gain more insight into the types of developments that actually would have a material effect on the company's period-to-period results, whether revenue changes or operating costs. The SEC staff, although it is focused on the use of non-GAAP measures, still wants to see key financial and operating metrics and understands that key performance indicators or KPIs can be very valuable to the investment community, not just to investors, but also to research analysts So the staff often frequently asks about the use of those metrics and how those metrics are calculated. The staff also generally comments on liquidity and results of operations. That's another, liquidity and capital resources, another area where the staff might request enhanced disclosures, particularly where there are trends that would affect liquidity. So that might focus on sources and uses of cash, the availability of additional cash to fund the company's liquidity needs, greater specificity or transparency in the contractual obligations table that companies are required to present in the liquidity and capital resources table. So all of those things come up in SEC reviews. Likewise, if it's a company that is highly levered or where there's a heightened risk of a default in meeting payment obligations, that's an instance where, of course, the SEC would expect to see more robust disclosure about financing sources, debt covenants, risks associated with non-compliance with the terms of debt agreements. And, of course, if it's a company that has a going concern qualification, then a lot of these comments would be heightened. So moving right along, goodwill is another area where the staff has requested additional disclosure so that readers have a better understanding about goodwill impairment. So their comments that one might see would relate to timing of impairment losses. So when the company has tested, how it's determined that an impairment exists, information about testing policies, the frequency perhaps, discussion of impairment testing might also come up in connection with the company's discussion in MD&A of its critical accounting estimates and critical accounting policies. So just to round out our discussion in terms of other areas of comment that are pretty frequent for life sciences companies and for registrants generally, fair value measurements. So in this context, the SEC staff is always looking for disclosures about the valuation techniques that companies are using, any significant unobservable inputs that may be used in connection with fair value measurements for hard-to-value assets. So that might include warrants, it may include other securities that it has categorized in level 3 in terms of the fair value hierarchy. Acquisitions are always a source of SEC focus. The SEC staff frequently asks about purchase price allocations, compliance with the pro forma requirements. A little bit later, Polya will talk about the proposed changes to the accounting significance tests and pro forma requirements, but for now this remains an area of SEC focus. Segment reporting always gets attention, so this may be of greater relevance for larger life sciences companies or for companies in the health tech sector as opposed to pure life sciences where there may be a lower likelihood of having distinct operating segments. To the extent that there are distinct operating segments, the SEC staff generally wants to understand how the principal decision makers identify those operating segments and whether there is a good understanding of how each of those segments accounts for items, and in particular, if the company relies on non-GAAP measures, whether registrants have inappropriately included non-GAAP measures in their segment disclosures. Another issue that is coming up more in recent comment letters relates to state sponsors of terrorism. So for larger companies that already have sales and may have sales in companies that may be on the State Department list, you see a sample comment there on the next slide relating to additional disclosure about the significance of sales into those countries or revenues or other sources of income that are coming from sales in sanctioned countries. So with that, we're going to turn back to Polya to talk about recent accounting pronouncements in a little bit more depth.
Sure thing, Anna. So very recently, 15 days ago, on November 15th, the FASB came out with a new accounting standard update 2019-10, which introduced a new philosophy or a new model that the FASB intends to apply going forward with respect to transition provisions for new accounting standards. Why did the FASB do this? Because a few years ago, right before the new revenue standard was issued in 2016, they introduced a definition that has been very much in this space and in the securities space. It's called public business entity, and includes not only the SEC registrants, but also private companies whose financial statements are lending for some reason into an SEC filing of another company. For instance, a significant 305 investee or a significant equity method investee under 309, a real estate operation that's reported under 314, a guarantor entities whose financial statements are reported in another entity's SEC filing, and so on and so forth. So we had a long list of businesses that otherwise would have qualified to be privately held companies and were not ready to adopt a standard on an accelerated basis, fall within this definition of a public business entity, and had to adopt early under the FASB model just as an SEC registrant. And that was causing challenges, a lot of concerns, mostly among the preparer community, not having enough resources to retain to help them transition more quickly to new accounting standards like revenue and leases. And so in anticipation of CECL and other major accounting standards, the FASB came out with a new model or a new philosophy for transition that they will apply going forward. And it boils down to the two buckets that you see on this slide. Bucket one would be all SEC filers that are not small reporting companies as of November 15, 2019. Those would be considered the first bucket, the first category of companies that would adopt on the earliest possible transition date a new accounting standard. It would also consider any company that is undergoing an IPO registration statement, because a company that is undergoing an IPO process usually doesn't know for sure during that IPO process whether it would qualify to be a small reporting company. And if it does qualify to be a small reporting company, it would happen after November 15, 2019, since that date is already in the past. Category 2 would be the small reporting company SEC registrants, other public business entities, those whose financial statements lend into an SEC filer's registration statement or filing under Rule 305, 309, 314, and others, not-for-profits, employee benefit plans, and private companies, the largest category of companies that apply U.S. GAAP. Now, how is this new model going to translate for some major standards that are about to be adopted by a large portion of U.S. GAAP reporting companies? If we look on this slide, the credit impairment standard would continue to be effective and adopted in the first quarter of 2020 by SEC filers, excluding the small reporting company filers. So those SEC registrants that were SRCs as of November 15, 2019 would qualify to adopt the new CECL standard in 2023, just like a private company. But all the other SEC registrants would have to adopt in Q1 of 2020. And so we have a 3-year lag between when all SEC registrants adopt and the later date, 2023, when the small reporting companies and all private companies and not-for-profits and other entities would adopt. Now, if an SEC filer becomes a small reporting company, let's say in 2021, or was a small reporting company now, but loses its SRC status in 2021 during that intervening 3-year period, that wouldn't change this transition approach because they get locked in either bucket 1 or bucket 2 as of November 15, 2019. And so when the standard came out, if you were a small reporting company as of November 15, 2019, you lock yourself into bucket 2 and you get to adopt CECL in 2023. So the standard is written this way to minimize the ins and outs and the uncertainties of what happens with the company during that 3-year transition period between the early adopters and the bucket 2 adopters. For leases, since leases is already adopted by all PBEs in 2019, in Q1 of 2019, the extension that was provided is only 1 year to 2021, and it is only for all other entities that are not PBEs and not-for-profits and EBPs. So basically, we have a 1-year extension for all of those that have not yet adopted leases. And so hopefully this is a timely update and answers a lot of questions on credit impairment that is looming on the horizon for Q1 2020. Now, we spoke that revenue recognition and leases, the 2 new major standards of the FASB, have already been adopted by substantially all SEC reporting companies that have a calendar year end. We spoke a little bit about some of the more common SEC staff letters on the revenue recognition model. And since our primary audience on this webcast are folks with securities law and business transaction law background, we figured to just give you a flavor of how subjective and complex these standards are by providing a few examples. And of course, you could read more and more deeper examples in the life sciences space in the 2 publications that we have attached for you. So let's take one example with respect to the new revenue recognition standard. This is how do we account for R&D services that are provided over a 3-year period by a biotech for a pharma company. And so very simple example, the biotech, the pharma company agrees to pay the biotech a fixed monthly payment for the R&D services and a $5 million milestone payment upon the enrollment of 100 patients in a phase 2 clinical trial in this particular example. So intuitively, for folks that are not that deep into this particular accounting standard, it may feel like we have 2 things to account for: the $5 million milestone payment on the one hand, and the 3-year R&D service, which is provided evenly on a monthly basis. And a registrant could certainly conclude that those are 2 distinct performance obligations and allocate revenue accordingly and so on and so forth, or what meets the eye, so to say. But the accounting analysis provides for 2 other options at least, and we've laid those out here in the next 2 paragraphs. And the first one is the registrant concludes that the services, the R&D services over a 3-year period, and the milestone research on 100 patients, enrollment of 100 patients, are one combined performance obligation. This is the only element over which revenue is allocated, and that total amount of revenue is recognized evenly over the 3-year period. In the second one, the biotech concludes that they have a single performance obligation, but also a series of distinct services, and that the enrollment of the 100 patients is a distinct service within that series. And so in that case, they could make an argument that they would allocate a portion of the revenue over that particular distinct service, and that is the $5 million milestone payment, recognize it over the period and by the point in time in which the 100 patients are enrolled, and then independent of that, recognize the monthly R&D service revenue. So quite different of if you picture revenue over time and how it's distributed on a monthly basis, very, very different outcomes depending on which accounting choice the company takes. Very, very subjective, right? So you could have a couple of companies that have the same arrangement, but they're concluding based on a deeper analysis for their particular space and their practices that either outcome A or B would make more sense and applied consistently as an accounting policy going forward. So the devil is in the detail, which is why the SEC staff has been so focused on companies fully and thoroughly describing their revenue arrangements and exactly how they're recognizing revenue for those particular revenue arrangements so that investors have an understanding and a basis on which to spot differences in accounting policies between registrants with seemingly comparable agreements otherwise. Now, on the next slide, we are giving you another example of accounting for customer options. So in this case, a medical device manufacturer contracts with a customer to provide cancer screening device, perform installation services, and provide 50 consumable cartridges to be used with the device. The medical device manufacturer also offers the customer an option to purchase up to an additional 50 consumable cartridges in the future at a 25% discount from the list price. And so the question here is this discount a separate performance obligation? And if it is, we will have to allocate a portion of the total consideration from this contract to the discount and recognize it later when the discount is taken advantage of by the customer. In this particular case, most likely, because the 25% discount is not provided to all other customers, but only to those that have, contracted with a medical device manufacturer, obtained the screening device, the installation services, and the first 50 consumable cartridges, we would conclude that the discount is substantive, and hence it represents a separate performance obligation. Now, the FASB also came out with an accounting standards update that provides some targeted amendments and clarifications to ASC 808, which deals with collaborative arrangements. And it says that if the other party to your collaborative arrangement is a customer, you would account for that particular component in the arrangement under the new revenue standard. So basically, you would treat it as a revenue contract. If it is not, you could look to other GAAP, including analogizing back to the revenue standard in the absence of other GAAP. And so this is effective from Q1 2020 for public business entities. Just a reminder that your clients would have to document how they're complying with this particular provision and more fine-tune their analysis and parsing through who are the other counterparties to a collaborative arrangement, and are they customers? And if they're customers, make sure that those components are accounted under ASC 606, which is the new revenue standard. So the leasing standard, ASC 842, is the second major standard to which life sciences companies have devoted a lot of attention and implementation effort in 2019. Short reminder for everyone that is not as familiar with the standard. For lessees, what it does is it basically puts up all lease-related assets and liabilities on the balance sheet, except for very short-term leases with a period of less than a year. And for lessors, the new guidance modifies the lease classification criteria and eliminates an old concept that we used to have under FAS 13 called the leverage lease accounting model. Now, the judgments and accounting concepts under ASC 842 are more specific and prescriptive. It is a very, very detailed standard, and it does not leave as much room for judgment as the revenue standard. So if we had to compare the two, the leasing standard requires much more specific subject matter expertise, but it also has a lot of crutches built into the standard and a lot of rules of thumb that help registrants come up with a more uniform accounting answer compared to the revenue standard. There are a couple of accommodations that the SEC staff has provided and has made statements and issued interpretations in their financial reporting manual with respect to the leasing standard. First of all, many registrants wonder, what do we do with our selected financial data table when we adopt the leasing standard and we put up all these assets and liabilities on the balance sheet, and the balance sheet looks very, very different going forward. Some registrants adopt the new leasing standard on a prospective method. Others adopt it on what is called the modified retrospective method, where they bring the assets and liabilities and new lease accounting to the initial period of application. And the staff has told us that your selected financial data table, 5 years, would need to reflect figures that are consistent with the financial statement periods, only to the extent that the financial statements have changed themselves, and basically match figures between the selected financial data table and the financial statements included in the filing. The earlier years that are not touched or impacted by the modified retrospective application of the new leasing standard would not be modified, but the registrant would simply include footnotes and other disclosures to alert investors as to why we have disparity in some of the line items and figures among the 5 years. And just a reminder on subtopic 11M, which requires us to provide disclosures about the pending adoption of a new accounting standard. Some registrants, particularly emerging growth companies that have elected the private company transition approach to the new leasing standard, have not yet adopted this standard, even though they're public companies or SEC registrants. So for them, as over the next year or a few quarterly periods, the staff would expect to see more and more detailed subtopic 11M disclosures that speak about the expected impact on their financial statements from adoption of this standard. So at the minimum, the staff expects disclosures that assets and liabilities would be included on the balance sheet with respect to leases. If they have any legacy arrangements that qualified for sale leaseback or some of the other specific types of leases that are going to be impacted significantly by the new standard, that would have to go into the disclosure. And then as the quarters elapse and we approach the adoption date, the subtopic 11M disclosures would have to become more granular and provide an expected impact down to a quantitative figure presented in there. Now, the definition of a lease within the life sciences space could be complex, and we may have contractual arrangements that are titled very differently from a legal perspective. They may be called supply agreements. They may be called R&D agreements or contract manufacturing agreements. But at the end of the day, when they're subjected to a deeper accounting analysis by an accounting SME, the accounting for that particular contract may end up being basically the accounting for a lease. And we wanted to give you an example of that to kind of keep your clients on the lookout and, basically go beyond the titling of a contract and into the substance of it in question. Do we have a lease here? And if so, the very complex and specific disclosures related to that new leasing standard would have to be provided, which is very different if the contract is an old-fashioned services agreement for which you provide very basic and minimal disclosures. If you have a lease, you will have to provide very prescriptive and voluminous disclosures. So let's look here at an example of a contract for manufacturing of particular medicine. Biotech enters into a 3-year arrangement with contract manufacturing organization for a dedicated production line to manufacture product X. The contract states that the biotech has the exclusive use of the production line, even though the CMO entity owns the production line, and that the manufacturing entity, the CMO, cannot utilize the production line for any other purpose except this particular product and manufacturing quantities of it at the request of biotech. So even though this is titled a contract for manufacturing of a medicine or a product, end of the day, the analysis likely would conclude it is a lease for a production line because the production line is very specified, and the biotech has full control over how that particular specified asset is being used over the 3-year period. Now, medical device companies often enter into arrangements with hospitals to provide an equipment lease and some non-lease components. This is very, very common. Sometimes the equipment is leased, and that portion of the arrangement would be tied to the lease, but it may be for free or it may be for nominal consideration contractually. The other components within the arrangement, like, for instance, supply of consumable products that are used in that particular equipment, may bear the bulk of the consideration or the exchange of value between the parties. And so the complexity here is mostly around identifying what are the lease and non-lease components, whether it is okay to group and lump the non-lease components with the lease components, which could be done under the new leasing model in certain circumstances. And if you're grouping and lumping in one, you would be recognizing that all the consideration allocated to those elements as a lease. But if you're not grouping, the accounting becomes more complex because you will have to track and account for elements separately. And so there is much more complexity. This is probably the one portion of the new leasing standard that is as subjective and complex as the revenue standard, how we group leasing and non-leasing components. And another area to alert our audience to is the lease commencement date. A lease commencement date is basically the point in time when consideration or payments start becoming exchangeable between the lessee and the lessor for an accounting purpose. This is not the beginning of the lease term, which is a legal concept. And so accounting begins on the lease commencement date. That is the date on which we are putting up on the balance sheet lease-related assets and liabilities and begin impacting the P&L going forward. But from a legal perspective, you may have a lease beginning or term beginning date, which is earlier or later than the commencement date. And so this creates further challenges because the contractual obligations table in MD&A is supposed to be for all contracts that are in place and legally enforceable. So if you have a large number of material lease contracts where your lease commencement date is January of 2020, but the legal term of the contracts began, let's say, on December 1st of 2019, technically you're supposed to include those contracts and expected future cash outflows for them in your contractual obligations table earlier than the accounting begins in the financial statements in January of 2020. So we could have some material differences. Those don't end up being material in most cases because it's one or two leases. But further screening should take place to ensure that if registrants have a very large number of similar leases and they have significant disparity between the beginning of the lease term and the commencement date, they may have to provide additional disclosure in MD&A to give their investors an understanding of the additional cash outflows beyond those that are included in the financial statements.
So I'm going to pick up and talk about some other SEC disclosure issues. And we'll start with thinking about this year's risk factors section and potential changes to risk factors in the future that might be taken into account in drafting this year's 10K risk factors. So the SEC has continued with its disclosure effectiveness initiative. And as we'll talk about on the next few slides, the SEC continues to review the Regulation SK requirements and trying to identify disclosure areas or disclosure requirements that may be repetitive, that may be outdated, that could use or would benefit from some simplification or updating. So in the summer, in August this year, and the comment period ended in the fall, the SEC proposed a number of changes to risk factors, including that companies include a summary risk factor disclosure if their risk factor section exceeds 15 pages. So for the average life sciences company, given the need to include risk factors relating to regulatory matters such as FDA approval processes, IP disclosures, IP litigation disclosures, most risk factor sections are well over 15 pages. So while this requirement is not yet effective, it's a good idea to think about a summary overview. The SEC, in its proposing release, also noted replacing the disclosure standard that currently discusses the most significant risk factors to material risk factors. Of course, I think that in most discussions that management teams have with counsel, they talk about and think about all material risk factors. But nonetheless, it's important to know where the SEC is headed. The SEC also, in its proposing release, is suggesting a requirement that risk factors be organized under relevant headings. So I think many companies already have adopted this as a way of organizing their risk factor sections, but again, a useful reminder. In terms of risk factors that the SEC has been focused on, we've now seen that various SEC representatives, including SEC Commission Chair Jay Clayton, the head of CorpFin, Bill Hinman, and others recently have spoken at conferences and at other gatherings about the types of disclosures that they expect to see in this year's annual reports relating to a few topic areas. So LIBOR, for life sciences companies that have financial obligations, whether it's bank facilities or borrowings, other notes or secured lending facilities that reference LIBOR, they may want to consider addressing any changes that will result following the discontinuation of LIBOR and the change to an alternative reference rate. For companies that have operations in Europe and that may be affected by Brexit, the SEC staff has noted that it's going to be looking at the types of Brexit disclosures that companies are including, and has noted that they're looking for tailored disclosures of Brexit risks. So we're well past the sort of generic description of Brexit-related consequences, and the SEC staff is now looking for very pointed, custom-tailored disclosures about how employees, headquarters, regulatory approvals, and so on may be affected, rather than general statements. The same goes in terms of cybersecurity. So in February of 2018, the SEC published guidance that essentially reiterated prior advice and prior guidance from the Commission relating to disclosures of cybersecurity risks and the occurrence of cybersecurity breaches. SEC representatives have been emphasizing in recent comments that they're now looking for companies to present much more specific, more custom-tailored risk factor disclosures relating to cyber security, and in particular relating to existing or past cybersecurity incidents. So rather than having a risk factor that generically discloses the risks that may result or the events that may result from a cybersecurity incident, if there has actually been such an event, then specifically addressing that and addressing the fallout or the consequences of such an event, whether it gave rise to internal investigations, to enhanced oversight of cybersecurity matters, or resulted in any loss contingencies, then all of that should be discussed. Tariff issues. So for companies that actually have product sales and that may be impacted by tariff issues, or companies that rely on foreign employees or on consultants and have suffered from the impact of changes in immigration policies or travel bans, then that as well should be disclosed. As I mentioned, as part of the Disclosure Effectiveness Initiative, there have been various waves of changes to Regulation SK. And so a number of changes relating to disclosure updates and simplifications became effective this summer. Companies may have already dealt with some of these changes in connection with preparation of 10Qs, but this is going to be the first 10K season where companies will have to address many of these changes. So there were additional changes made to MD&A, allowing companies the flexibility to deviate from the historical presentation that companies had been using in MD&A, and now allowing companies the opportunity to present their results of operations in any format that's likely to enhance a reader's understanding of the company's financial condition and its results of operations. Also, eliminating the need to include the earliest year in the 10K if that prior year has been included in a preceding Exchange Act filing. Also eliminating the requirement to discuss 5-year selected financial data in the context of trend information. So those are all important changes. I would anticipate that there'll be a slow evolution in MD&A disclosures, and that there may be some reluctance to eliminate that earliest year in MD&A sections. As far as property discussions go, SK Item 102 has been revised so that now a discussion of physical properties are only necessary if they're material to the registrant. So for example, for life sciences companies that have limited physical operations and rely on virtual office presences, maybe they eliminate some of the properties discussion. And there have been substantial changes to exhibit-related requirements. I'm not going to go through these in much detail. All of these changes are particularly beneficial for life sciences companies because they have resulted in making the whole process of confidential treatment requests all but a handful have been eliminated. Companies can now omit confidential information from material contracts, applying the same standard that has always been applicable to CTRs, but without the filing of a confidential treatment request. Important changes relating to cover page disclosures. So the 10K has to include the trading symbol for each class of listed securities, and for companies that are already required to use XBRL, then there's a need to data tag on the cover page. This will also be the first year that many companies will be moving to include critical audit matters, or CAMs, in the audit report. So CAMs are intended to provide readers with a better understanding of those matters, material to the financial statements that require subjective or complex audit or judgment. So this is different from and distinct from the critical accounting policies discussion that companies include in their MD&A and in the notes to the financial statements. The CAMs are going to be part of the enhanced audit report. And while CAMs are not applicable to EGCs, they are going to be applicable to most reporting companies. And we've already had some early experience with CAMs. We've already seen that large accelerated filers that have June 30 year ends have filed the enhanced audit report with CAMs and include two to three critical audit matters in their audit reports. So it may be useful to look at some of the precedent there. CAMs may include items like goodwill impairment, intangible asset impairment, may relate to certain questions on revenue recognition, income taxes, so things that involve substantial judgment. In connection with inclusion of CAMs in the audit report, it's going to be important for audit committees to spend additional time discussing these items with the company's auditors, and also for the preparers of MD&A disclosures to think about how their MD&A disclosures might align with or complement the CAMs identification in the audit report. So we're just going to finish up our comments with some really quick comments on upcoming items to watch for. So as I mentioned earlier, there is continuing rulemaking in the area of disclosure effectiveness. The SEC has proposed additional modernization of Regulation SK. So these changes to Reg SK are still pending, and they relate largely to business and legal proceedings. So with respect to business and legal proceedings, more of a principles-based approach, less formulaic, less prescriptive disclosure requirements. In business, some of the changes would include expanding disclosures relating to compliance with environmental laws to include compliance with all governmental regulations, enhanced human capital disclosures. So this is kind of an amorphous concept. More and more companies have been focused on providing more disclosures about employees. And so the types of disclosures that might be required going forward may relate to a company's employee base. Whether there's a reliance on contract workers or on staff that is not considered employees, whether there are issues with recruitment and retention, whether there are special measures that the company takes with respect to ensuring continuity of the workforce. With respect to legal proceedings, the proposed changes include modifying the threshold for environmental proceedings. And so with that, I'm going to just turn it over to Polya for some last observations on the proposed changes to the accounting significance tests and pro forma requirements.
Yeah, and we have only a couple of minutes left, so we'll try to touch on the highlights of this proposal. It is very long. It contains, it's touching on a lot of rules, and it would be, if adopted as proposed, a very significant change to how we perform significance tests to conclude which acquisition is significant. It would also change the significance threshold only for dispositions, not for acquisitions, but for dispositions, it would move the significance level from 10% threshold to a 20% threshold, so meaning fewer dispositions would trigger pro forma reporting on Form 8K for domestic registrants. the significance tests would be revised to make them more practical, to iron out certain kinks in them that have been observed by the SEC staff over the years, where just because one of the three significance tests results in a greater than 20% ratio, we end up concluding the acquisition is significant and report separate financial statements pre-acquisition for the target company and pro forma information, even though the annual figures used in that significance calculation may be distorted or unusual either for the target company or the registrant. And so to help with that distortion and get to a status of play where we are going to have fewer anomalous results, they are fine-tuning the investment test to make it a fair value to fair value comparison between the purchase price for the target company and the equity fair market value of the registrant. And they're also modifying the income test to include a second element based on recurring revenues of the target to recurring revenues of the registrant. So hopefully that helps going forward with resolving anomalies and creating fewer situations where companies feel compelled to seek relief from the SEC staff on reporting 305 financial statements. The proposal would also eliminate the third category of significance, those greater than 50% significant, that triggered 3 years of pre-acquisition audited financial statements for target companies. And it also introduces the concept of abbreviated financial statements in a new rule within 305E that would codify substantively current interpretive practice around when is it okay to provide abbreviated financial statements for a target company instead of full carve-out financial statements. But most importantly, pro forma information under Article 11 going forward would look very, very different compared to current requirements under Article 11. Of course, if the proposal is adopted as proposed, we will have two categories of adjustments: transaction accounting adjustments that would be very similar to those pro forma adjustments we prepared today to basically step up the assets and liabilities of the acquired company and bring in commensurate depreciation, amortization, and other charges associated with the new accounting. And then we will have a new category of adjustments called management adjustments, which basically would be bringing into the total of the pro forma any cost savings, synergies, and maybe even growth in revenue that are reasonably expected to occur. And so these would be effectively building in expected results, expected projections into the pro forma information. So quite a lot of a change. There would be basic and diluted earnings per share for all of these columns that you see here on this slide. And this is again at the request of CFA Institute, which represents the large institutional investors and sophisticated investors in the public company markets. So for those of you that are interested in submitting comments, the deadline is already over, but the SEC staff are still considering feedback on this proposal, and given how significant it is, we would encourage you to think about submitting a comment letter despite the deadline being over.
All right. Well, that brings us to the conclusion of our time today. We did not touch on the new standards for smaller reporting companies. It is in connection with 10K season, again, worth revisiting the changes that the SEC adopted to the SRC standard, as well as all of the other changes that we've talked about to Form 10K and to the 20F requirements resulting from the SEC's Disclosure Effectiveness Initiative. So with that, we thank you for joining us for today's presentation.